Did you attend it? Nice. So too soon. Eh? Did you? Did you attend? This is your first class? First? Or you've been attending online? This is your first class? Okay. All right, please, if you have not attempted, please go back to the, what's it called, the videos. Try to go through the videos and then see if you can attempt the assignment. They're actually basic assignment. And like I told us in class, those are not the kind of questions you actually expect in the exam. Rather, it is to do what? Just to build, your understanding around cost of capital. And that's the essence of that assignment. Please, I want everyone to go back and attempt for those that have not done it. All right, so before we move today, basically what we have is project-specific cost of capital. But before then, we'll just look at 2 questions from your Pathfinder very quickly. Cheap questions, 20 marks. I'll just try to do 2 of them, and then we move to what we have for today. And the first question, it's November 2022, question 3. Illustration 1, November 2022, question 3. All right, please, earlier I sent the compiled Pathfinder to our group. Please, if you don't have it, just go to the group and hold on, let me confirm that. I think it should be.
Mr. Chris, which question? You said November 2022.
Yeah, November 2022, question 3. Kakai ZK. Are we out there? Please open on your device. Just search for Zakai. Zakai. Online, are we there?
Yes, sir.
Yes, sir.
Yes, sir.
All right, please. I need everyone to open the question on their devices. So when I take it off, you still have, you can make reference to the question. Guys, please open the question on your phone or your tablet or your systems or whatever device you're using. If you are there, I'm there. Can we move? Online, can we move?
Yes, sir.
Yes, sir.
Yes, sir.
All right. All right. Zakai ZKPLC is a listed company that owns and operates a large number of farms throughout the country. A variety of crops are grown. Financing structure. The following is an extract from the statement of financial position of ZKPLC at 30th September 2021. Please take note of the date. At when? 30th September when? 2021. It means these figures are given to me are balance sheet figures as at the end of what? September 2021. Is that not? And remember that they are all what? Closing values. Is that true? Yes. Now we have ordinary shares of 1 naira each, 200 million, reserves 100, 9% irredeemable 1 naira preference shares 50, 8% loan stock 2022. Now, what this means is that anytime you see this loan stock or the debenture and then you see a year in the front, they're only telling you the redemption period or the conversion period of that debenture or that loan. Do you understand what I'm saying? Now look at this balance sheet they gave to us. That when 30th September, it means this loan should have how many years to redemption, guys? How many years? Just 1 year, obviously. So in 2022, this loan should be redeemed. If it's convertible, in 2022, this loan should be what? Should be converted. All right. The ordinary shares were quoted at how much? 3 naira what? XD on 30th September 2021. 2021. Don't forget that this becomes our time zero, true? And then this becomes our D0. Is that not? Oh, sorry, the MPS rather. Sorry, this is market price, Abi. MPS. XD. Okay. Now, the beta of ZK PLC's equity shares is how much? 0.8. The annual yield on treasury bill rate is how much? 5%. What does this information mean, guys? RF, right? Risk-free rate. And financial market expect an average annual return of how much? 15% on the market index. This becomes my what? RM. The market price per preference share was how much? 0.9 XD on 30th September 2021. Loan stock interest is paid annually in arrears and is liable for what? For tax at how much? 30%. The loan stock was priced at 100.57 x interest per 100 naira nominal on what? 31st September 2021. Loan stock is redeemable. Look at when? On September. Even if you are not giving this, guys, you already know when that loan stock is going to be redeemed. But of course, the question still told us. Assume that taxation is payable at the end of the year in which taxable profit arise. Now look at this now. A new project. Difficult trading conditions have caused ZK PLC to decide to convert a number of farms into camping sites with effect from the 2022 holiday season. Providing the necessary facilities for campers will require major investment, and this will be financed by a new issue of what? Loan stock. The returns on the new campsite business are likely to have a very low correlation with those of the existing what? Existing farming business. What does this information mean? Look at. You know they are into what now? What are these guys into? Farming, Abi. What are they saying? Because they are not making so much revenue and all that, they want to move that farming into what? Into a camping site. Now they are now saying, look at this information. The returns on the new campsite business are likely to have a very low correlation. What does that mean? the return on the camping site is going to be having a low correlation with those of the existing farming business. What this is simply saying is that it means that the risk of these two businesses are going to be unrelated in a way. So meaning that if I was into farming and I'm changing the whole farming structure into a camping structure, it means that the risk for these two businesses will not be the same. If the risk cannot be the same, it simply means also that what the better of the business will not what will not be the same. Remember our better asset and better equity we explained in our last class, right? Now let's look at the requirement. Using what? The capital asset pricing model, calculate the required rate of return on what? On equity. What are they asking for here? KE, is it not? Of ZK PLC as at when? Don't forget. 30th September 2021. Look at what they now said. Ignore the impact from what? From the new campsite what? Project. What it simply means that because you know that if they want to go into this campsite project, you have to start adjusting that better. But the question is asking you now to do what? To ignore that impact. Now look at this for a whole 3 months. And I'm sure, please, pick your calculator and tell me what the cost of equity is from this using, what did they say we should use again? CAPM. So if you are using CAPM, guys, what should we do?
Network is very bad.
Look at the information very well, everyone. We have the equity beta, which is not changing to we have the market return 15%, the treasury B rate 5%. What should be my cost of equity using capital asset pricing model? And this is max. How many? 18. Yes, any other figure? Online figure. You have the figures, sir. Okay, so let's do it together quickly. First thing first. Oh, how many? 18%. Are you sure? 8. 10%. Okay, 13%. All right. So now, first thing first. Look at, they already told us one method to use. We don't have to even think twice. So illustration
30%.
1.8. Fantastic. You sabi book. So calculation of yeah. Now, ṣe la máa ṣe sí. Okay. Okay, kò sí wàhálà. Okay, kò sí wàhálà. Sorry. Calculation of costs of equity. Using what? Capital asset pricing model. And according to that, we say
Your screen is not moving, sir.
Others, please confirm. Can you?
Yes, sir, it's not moving.
How about now?
It's blank. It's not showing yet.
RF is risk-free rate.
We are still on the question page.
Beta. Please confirm I-bar now.
It's blank.
It's trying to come up.
Is it like that for everybody, please?
Okay, it's up now.
All right. Then RM is what, guys? Market return, right? Market return. And I already told us to note that when they give you RM minus RF is same thing as what you call risk what? Premium, right? Because they are giving to you is premium, it means that RF risk premium. All right. So guys, let's get the figures. KE equals to RF, I believe is 5% plus beta is 0 point into what? 15% minus what? 5%. How much is it? 13%. Guys, 3 marks for doing nothing. This was an exam. 13%. All right, so let's look at the B part of the question. Any issue? Anybody? Sharp. What's the B? Come on. 2 marks for doing nothing. All right. Implication of what? Implication of beta less than what? Less than 1. What does that simply mean? You all know, Abi. When beta is less than what? Than 1. What does that mean? It means that the business, Abi, the business risk of the project is low, Abi, than what? Than the market risk. Market risk. That is, if market moves by 10%, what will happen? The volatility of the business will move by how many percent? Volatility. Volatility of the business will move by how many percent? 8%, I mean. Is it not? Remember, market risk is what? 1, Abi, which is 100%. Your own is 0.8, which is how many percent? 80%. So you are saying the market moves by 100. Your own will move by how many percent? 80%. You can also say if your own moves, the market risk move by 10%, yours will move by what? 8%. Also, if you move by 1, yours will move by 0.8. Anyhow you want to put it, same thing. All right, so we are done with this. 2 marks. Next is what? Yes, calculation of the weighted average cost of what? Cost of capital. Please take note, all you need to do in this kind of question is to go to the balance sheet and look at the sources of finance that they have. So you now list them out just to guide us. From what I can see here, look at how many do we have? We have 2. We have equity first. Is that not? Equity is there. We also have what? 9% revenue. And then we have what? Low stock when? 2022. Is it not? Right. So let's start with equity. We already have. So our sources of finance. Now, let me show us something. Look at this requirement. Look at what they said. Calculate the weighted average cost of capital of ZK PLC as at 31st September when 2021. Use your what? In answer to requirement what? E. And then above for the cost of what? Equity. Ignore any impact from what? From the new counter. There's no need for us to start at the same cost of equity stands. Do you understand? So it means, so we have equity. Is that? What's the next? We have a preference, Abby. Preference shares.
We can't see this.
And then we have what?
I can't see your
Loan stock,
box.
Abby. Loan stock.
Mr.
These are the three.
Mr. Chris, your screen is still not moving.
It's not moving. Please, could you check your network? And others, please confirm that it's same for all of you.
Okay, it's I
not
see it
moving.
now.
Moving. I think it's now.
Okay. So for each of these sources, what are we expecting? We need two parameters for each of them. We need the cost and what? And the market value. Cost, market value, cost, market value. Is that not? So let's start with equity. So our cost of equity equals to 13%, Abby, as computed in A above. So you don't have to start recomputing. Just make a reference to what you have done before. Again, we need to get the market value of equity. And how do you get market value of equity? Simply number of shares multiplied by what? Market price per share. Is it not? So what's the number of shares there from the question, guys? How many shares do we have? 200. Remember, there's 1 error by the side, Abby. So it means you are 200 divided by 1. If you have 0.5, there to be 200 divided by what? 0.5. If you have 0.4, to be 200 divided by 0.4 to give you a number of shares. Not multiplied by. Please don't make that mistake, right? Simple. So here we have 200 million shares multiplied by what? MPS is how much?
3 naira.
3 naira per share. Fantastic. And that should give us how much? 600. And then all market values in what? In million naira. Save myself the stress. All right. So we have the two parameters that we need for equity, cost of equity, market value of equity. So we move to the next one, which is what? Preference shares. And again, we need two things, Abby. First, we need the cost of what? Preference shares, the market value of what? Preference shares. The cost of preference shares, just think of it like the same way you calculate your cost of what? Cost of equity. That what? Preference shares is traded. They told us the market price of that preference shares already. Is it not? Can we all see that? Anybody, how much is it? 0.9. The next thing is the dividend you're paying on that preference share. Remember that it's fixed. And that fixed amount is a percentage on the nominal value. The nominal value of that preference share they gave us to be how much? No, not the nominal value by unit. One of 1 naira is how much? That's so we have preference dividend divided by the market price of the preference shares. So the preference dividend should be 9% of how much? 1 naira. And that should be how much? 0.09 divided by what is the market price of the preference shares? 0.9?
0.90.
Yes.
0.90.
So I want to believe how much? 10%? That's 0.1. This is the cost of our preference shares. Anybody struggling yet? Online. Are you good? All right. So the market value, how much is it? Market value of anything, don't forget, if it is trading, right? So the market price divided by nominal value multiplied by what? By the book value is what gives you what? The market value. So here, our market value equals to the current market price divided by the nominal value multiplied by the book value. So what's the market price? You said 0.9, Abi? That's 0.9 divided by the nominal value is 1, Abi? 1 error multiplied by what's the book value of preference shares? How much? The book value, 50. And that should give us how much, guys? 45.
Mr. Chris, please, can you explain these preference shares again? Like
Okay, which one now? There are two parameters there. Which of them?
the first one.
The first one, cost of preference shares.
Yes.
As much as possible, I try to explain this, how these things are derived, so you don't cram it. If you want to calculate the cost of anything, just look at it from the perspective of equity. When we're calculating cost of equity, we say the dividend, divided by what? Divided by the market price. All we are saying here is that if I give a business money to invest for me, to the company, I told us that it is a cost because I'm paying out dividend to the shareholders or to the investors. But to the investors, it is what? It is a return for them. Now, if you want to calculate the cost of getting money from these investors, what you should look at is first, how much are you getting in return of this amount of giving to them? And they say they are giving you a dividend of say 10 naira, 20 in case maybe. So if they give you a dividend of 10 naira, and the market price of that your share, 1 unit of your share is 20 naira, immediately actually is that because you have to sell that share in the market, your possibility cost is 10 naira, because you trade in the market. If you trade in the market is saying, I can buy 1 unit of your share for 50 naira, and the return you get on 1 unit of share is how much? Is 10 naira. You need the cost actually is what? Is that 10 naira divided by what? Divided by the market price. The same way you calculate on your return on equity, return on investment, or anything. How you calculate return on investment? How much you're getting, the profit from that investment, divided by what? Divided by the cost of that investment. In this case, we are looking at it like the opportunity cost of your shares. Because if you are to sell that shares now, you will have gotten the current market price. But because you are holding on to it, they are giving you a dividend of 10 naira. So if I divide 10 naira by the opportunity cost of that share, it gives me the market what's it called, cost of equity of that holding that shares. Now the same thing is applicable to preference shares. We are saying preference shares pays a constant dividend, more like interest, right? So now in this question, we are told that the preference share has a 9% obligation, meaning that the company must pay them 9%. Remember, anytime you see 9% of loan stock, 9% of this, it is always a percentage of the nominal value. Nominal value of our preference shares most times is assumed to be 1 naira. For debt, is how many? For debt, is how much? 100 naira or what? Or
1,000.
But for preference, is how much? It's 1 naira. So now it means here also the cost of this preference shares is the dividend I'm getting from the preference shares against if I'm to trade these preference shares in the markets now. How much will they pay cost of that preference shares? And that's what 0.9. So it means simply the dividend on that preference shares divided by what? The market price of that preference shares. And that gives me how much? 10%. Are we good? All right, so if you come to the trading value, they told us it's trading at 0.9. Remember, 0.9 always on the nominal value. It means this preference shares is trading at a discount of 10%. So meaning the book value and market value. So it means the book value will have to be adjusted downward by how many percent? By 10%. So that's what we're saying. So and that gives us 0.9 divided by 1, which is the nominal value, right? Multiplied by the 50, which is the book value. And that's why you can see now that the market value of this preference shares is trading downward to what? To 45, as against the book value of how much? Of 50. Does that make sense to you?
Yes, sir.
All right. So I think we're done with this. So we have the two parameters again now. What and what? 10% cost and then 45 naira or 45 million rather market value. So the next thing here is what, guys? Loan stock. Remember, the loan stock is redeemable. Is it? Is it a redeemable loan stock, guys? It is a redeemable loan stock. The cost of a redeemable debt is what? IRR. Fantastic. And again, we need the cost of loan stock. Yes. Yes, my cost is K. Yeah. It's deliberate, don't worry. All right. Cost of loan stock, KD, right? And then what will be the cost? Equals to what? The internal rate of what? Of return, which is what? IRR. To compute my IRR, what and what do I need? Number one thing I need is what? The market price. That market price must be given. Market price of loan stock. 100 naira. Is it 100? Okay, 100 point what? 57. What else do I need? I need tenor. What's the tenor of this loan stock? 1 year, Abi. So it has 1 year to redemption. The next thing I need is the redemption value, okay? Redemption value. If you are giving, fine. If you are not giving, always assume what, guys? 100. Did they give us? Eh? Are we assuming it? Assume, okay. So, and then we have our tax rate, 30%. 30%. So now let's start. Any issue, guys? Go ahead. What was it? 500 nominal value. The nominal value is not a problem, right? Which one? Is the redemption? Assuming the redemption value. This is even how much? What's the coupon? Tell me what's the issue now? Eh? Okay. I've said there are two things here. Hello? Hello? Hello?
All right, well, he's
Attach a laugh. All right. So the nominal value of your debt, any debt that is trading, can be 2. It can be 100 naira. It can also be what? 1,000. What does nominal value mean? Nominal value is used to calculate the market value and also to accrue the coupon interest on that debt. For instance, if I'm told that the loan stock is 8% nominal, 8% of nominal, right? It simply means that 8% of 100 is what I'm going to be getting as interest every year. That makes sense. It's a different thing from the redemption. The redemption value, because the debt is redeemable, when the redemption period comes, I'm expected to pay back this loan. How am I paying? Am I paying back at a premium? Am I paying back at a discount or at par? That's what we are assuming here. Some questions, they will tell you that redemption is going to be 5% premium, 2% premium or discount at the rest of them. But when they are silent, it means that the redemption must be at what price? Must be at what? At par. At par. Online, please, are we together?
Yes, sir.
Yes, sir.
Online.
Yes, we're together.
We are together, sir.
Fantastic. Fantastic. MOA. All right. So let's quickly. Yes. Any issue?
No issues.
Okay. So our NB, for the purpose of calculating cost of capital, the interest or the tax effect, the interest on the loan stock must be adjusted for tax shield. Tax shield. So our annual interest here, annual interest net of tax here will be how much? 8% of how much? 100. Is that not? Multiply by 1 minus 0.3. So that we have 8 naira multiplied by 0.7. And that should be how much annually? 5.6.
0.6, yeah.
Abi? So now let's set up. We have our year. We have a cash flow. We have our discount factor. And then we have our what? Our PV. Don't forget, we are trying to get the IRR. We have year 0, and then we have year what? Year 1. Our cash flow in year 0 is the market value. Is it not? Market value. And the market value here, outflow. How much? 100 point what? 100.57. Discount factor at, let's do 8%, Abi. Okay, so this is still 1 and this is still 100.57 outflow. Year 1, which is the redemption time, right? We are going to be having what and what? The redemption value plus what? Plus the interest for that period. So here we have our redemption plus what? Interest. Our redemption, we assume, is 100 plus interest is how much? 5.6. So that this guy will be what? 105.6. Help me, discount factor.
0.925.
0.925. 8%. All right, assume your figure is correct. Help me, what's the PV? Eh? 79. Abi, help me. How much is MPV? Eh? £2.78. So what do we do? Try discount factor. I'll just do 4%. I'm reducing it now. The PV, this is still 1. You can choose anything. But like I told us already, it is safer to work from 2 extreme rates. One that's giving you a negative and another one giving you positive. And I've explained that to you, even though some textbook will provide you alternative approach, but I think I'm more comfortable with this. All right. So what do we have? 4%.
0.962.
962. All right, help me multiply by 105.6. 101 5 5 59 MPV. Is it positive?
Sorry, Mr. Chris. Please, why are we not redeeming?
Why are we?
Not redeeming the because it's because is it 1 year?
Welcome back to class. Yes, it's redeemable in 1 year, 2022. All right, so our IRR equals to the KD, which equals to what? Lower rate, Abi, plus MPV, lower rate, divide MPV, lower rate plus MPV, higher rate, multiply, higher rate minus what? Lower rate. So our lower rate in this case is how much? 4%. 4% plus MPV 1.02, assuming your figure is correct, divide 1.02 plus 2.78 multiply 8% minus what? 4%. If you have a Casio calculator, help me. Final figure, please. Five points. Like this. All right. So next is to get our market value, Abi. Market value of the loan stock. The same approach. What would that be? Our market value equals to the market value over what? Over the nominal value multiplied by the book value. Any approach is fine, right? You will get the same. Market value of this stock is how much? 100.57, Abi? 100.57 divided by the nominal is how much? Per 100 multiply. What's the book value? 250. Giving me what you call 251.425. So let's get our work now. So we have our sources. We have cost. We have market value. Market value. We have total, or we have average. Sources, the first one is equity, Abi. Next is what? Preference. And then what? Loan stock. Cost of this, I can remember, is 13%. Can remember this is 10%. This is how much? 5.07%. Market value of equity is how much? Yes, 600. 600 for preference, how much? And then for loan stock, 251.425. Average, what's 13% of 600? Yeah, preference, 4.5. And this, say again, 12.7. 5. Okay. So we have total. What was the total of the market value and what was the total of the average? Say again. 25 and market value 896,425. So our cost work is simply average total divided by what? Total market value times 100 over 1. And that should be 95.25 divide by what? 896.425 times 100 over 1, giving me how much? 10.63%. Please take note, if you had a long-term loan and you're bringing it to this kind of table, remember you have to net tax of it. The reason why we are not bringing tax effects is because remember we already adjusted tax on this loan stock. So they're going to adjust for tax here again. Do you understand what I'm saying? All right. Are we good? Online?
Yes, sir.
Fantastic. I think we are done with this question though. 20 marks for doing nothing. Look at Abby. 20 marks for doing nothing. We are done. In fact, you guys solve this thing yourself. Look at this one now. For 5 marks, what did they say? Without further calculation, identify and explain the factors that may change ZK's PLC's equity beta during the year ending 30th September 2022. Without further calculation, what do you think? What do you think will change the equity beta? That's the E or the D. That's the D or B. May change what? What? ZK. Now look at, they made it easy for you. You know there are 2 betas. You have equity beta and what? Beta asset. Beta asset represents only what? Business risk. If they say what are the factors that may change beta assets, it means they are referring to it in the scope of only relating to business. If they say that they change equity beta, it comprises business and what? But is significant change in business risk. Abi, especially moving from agri to what now? To camping, right? And the volatility are unrelated or uncorrelated from what they told us. So that would definitely change the equity beta. Number 2, finance, Abi. Gearing. Increase in gearing of ZK within the year. What else can change it? Change business risk. Market factors. Demand trend, industry trend, etc. So you can look at government policies. etc. All right. So if you can just write 1 or 2 or 3, write 3 and then explain them, I think you're fine, and the impact on that.